Hello, my name is Eric Wilkinson. Many of you may recognize me from CNBC, Fox Business, and the Wall Street Journal, where I've commented on everything from geopolitical, economic, and market analysis. I've been trading my own money for over 20 years now, and I'm not here to tell you that I'm going to make you rich or that I'm going to make you a millionaire. But I am here to tell you how to take control of your finances, manage your own portfolio, and most of all, manage your own risk. And I've traded in most markets throughout my career on the floor of the Chicago Board of Trade, where I've traded everything from stocks, financial futures, commodities, currencies, and options on all of those products. This is an educational company, so you don't have to rely on anyone else. We're here to teach you how to implement trading strategies into your own accounts so that you can take control of your finances and manage your own risk. Got a little bit of housekeeping to go over. This disclaimer talks about how everything I talk about in this video tutorial is going to be hypothetical or simulated performance. Basically, I don't know if you've watched this video 2 years down the road or 2 days down the road. Things I talk about, the prices that we're talking about in these different slides are going to change over time. But having said that, we got to go on to the next disclaimer, that everything we talk about in here is to be implemented into your strategy after you've done your own homework. Most importantly, do your own homework. I don't know what your risk parameters are. I don't know what you have in your account. So some of these products or some of these strategies that I talk about may not necessarily be the right strategy for your portfolio. So do your own homework. And finally, please remember that past performance of any trading system or methodology is not necessarily indicative of future results. Guaranteed you've heard that before, if not just from me. This is going to be Options Basics Part 5. This is Part 5 in a series of several online tutorials that I'm going to be giving you different types of strategies that can be implemented into your IRAs or your trading accounts. If you're very new to options, please go back and watch some of the earlier segments that we've done on terminology and the history of these different products. The reason why is because I'm going to be using some of that terminology throughout all of the rest of these online tutorials, so it's going to behoove you to understand those front and back, like the back of your hand, I guess, if you will. In this one, I'm going to be getting a little bit more in depth. These strategies are going to be a little bit more detailed, I guess, if you will. So this one's going to be on short straddles, short strangles, the iron butterfly, and the iron condor. Now, the short straddle and short strangle are pretty much naked short selling options. And with the iron butterfly and the iron condor, we're going to be creating a bit of a defined risk strategy to the straddle and to the strangle. Short straddle. The short straddle is a sell straddle or naked straddle. You might hear it talked about in different ways, but I'm going to be just considering it a straddle from the short position. It's a market neutral strategy, which means that we don't want the market to move dramatically in any direction. These are going to be good for low implied volatility type of markets that we've had lately. And we're going to try and take advantage of the theta decay that we'll see, which is the time decay. We're going to be selling at the money call and an at the money put simultaneously. In most platforms, you can just pick straddle and it will prompt you to sell the at the money. You can sell it out of the money or in the money, but that's not the best way to implement this strategy. And we'll go over some charts and stuff like that, or some graphs a little bit later. We're looking for the underlying to trade in a very tight range, and at expiration, trade at the strike price of the strategy. Now, as anyone knows out there, it's very difficult to pick the exact strike at which a stock is or an underlying is going to trade 50 days from now, let alone a couple of days from now. But this strategy is going to be really needing to be watched, manage our risk. I don't like to watch anything go to expiration. I have a set of rules that I go by that I'll teach you guys in the online webinars and the in-room or online classes, I should say, and we'll go over specific details as to when you should enter these and when you should really be getting out of a lot of these. It's just too in-depth to go over today right now, but here we're going to be talking about the seller of the straddle has unlimited risk. Keep that in mind. Like I said, it is a naked straddle, which is like a naked call or a naked put. You have unlimited risk. There's no defined ends to these. The maximum profit is the underlying trading at the strike price of the strategy. For instance, if we were to sell a 60 straddle, we would want the underlying to be trading right at 60 at expiration. The max profit is going to be the net premium received minus the commissions paid. And I've told you before that I don't really like to add in a lot about the commissions paid, but when these strategies start getting 4 legs, you really have to start paying attention to the amounts of commissions you're paying, to whether or not these strategies you implement are going to be profitable or not. If you pick something that's so far out of the money on one of these 4-legged strategies, you're just not going to be collecting enough premium to cover the cost of your commissions. The maximum loss is going to be when the underlying moves sharply in either direction, causing the call or the put to expire in the money. Now remember, the max loss is going to be unlimited due to the fact that if the underlying goes to infinity, you're going to keep paying. Obviously, we know the puts can only go to 0, but if you sold Tesla put, that is a long way down. The max loss is going to have 2 separate max loss points, and so will the break-evens on all of these strategies. But the max loss here is going to be the price of the underlying minus the short call minus the net premium received. The max loss on the short put is going to be the short put minus the price of the underlying minus the net premium received. And we will go over some examples, but just to have you have this for your notes. And the break-evens, remember again, there's 2 possibilities. The call break-even is going to be equal to the short call strike price plus the net premium received. Or your put break-even is going to be your short put price minus the net premium received. This is going to be an example of our short straddle that we're going to be using. I'm going to use eBay as an example, specifically because this strike was trading very near to 60, which made it a little bit easier for the math and everything else here. As you can see, that was the only reason why I really picked it. I mean, I guess I did look at the implied volatility was relatively low. eBay's been trading in a range from basically 63 to around 55 for the better part of the year. So this just made for a very good example throughout this online tutorial. So here you can look at the bottom. I meant to make that a 1 lot, but it defaults to 10 for me, sorry. So anyway, but you can see for every 1 lot we are getting a credit of $3.98. Basically, the July 15 calls we sold at a strike price of 60, and the July 15 puts we sold at a strike price of 60. Now it's right there near $4. You're getting almost $2 per strike for this particular strategy. Remember, the closer to at the money you are, there is more value in that strike. So we got almost $2 for each. We got a little bit less for the calls and a little bit more for the puts than $2, but for educational purposes, you can see that that is going to be our max credit. If you look at the diagram, the white dotted line across the middle is our break even, and you can see that if it nails right there at 60, that's the peak of the pyramid. That is where we are going to gain our max profit. And where it crosses the dotted line is where we have lost our credit and we start going into negative territory where we are losing money. And as you can tell, those go on infinity for the most part. If you look to the left side of the screen at the bottom, those are our strike prices, or that is where the underlying would be trading at any given time. And on the top left is how much money we make and or lose. So, or along the left side, the vertical line, the horizontal line is where the underlying would be trading. So I'm going to be kind of using that throughout, so keep that in mind.